Ladies and gentlemen, welcome back to Finstep Asia Edge, talking about Web3, Web 2.5, Web 2, whatever interfaces with finance, blockchain, and fintech. With us today are the co-founders of Xals, who are doing very interesting things using blockchain infrastructure for finance. It's a great combination of two founders who've come from finance and technology, Supreet and Ashutosh. Why don't we start off with you both giving us a sense of your backgrounds and how Xals came about?
Okay, I'll start off with introducing myself. I'm Supreet. I'm the co-founder and the chief operating officer of Xals. We started Xals about 2 years ago, and my life before Xals, which now feels like it was a really long time ago, was about 15 years as a business operator. Large conglomerates as well as technology firms across South Asia, Southeast Asia, and Greater China. The last couple of years, I was with Facebook in Singapore. The years before that, I was implementing blockchain for a large conglomerate here in Greater China, and thereon it moves on. So a through and through strategy and operations person.
Ashutosh?
I'm the chief executive officer. Spent about 15 years all in banks. Started my career with Lehman Brothers and moved around with Nomura. And for the last 10 before Xals, I was with HSBC Group here in Hong Kong, primarily working in the treasury business.
And we're sitting atop what was known as the LKF Tower, overlooking Hong Kong mid-levels. So great weather today and great people to have a conversation with. Now, both of you have had this engagement, if I may use the term, with blockchain. So, yes, 2009 Bitcoin blockchain is what people want to talk about in terms of a milestone of when DLT really took off. But in essence, probably when Ripple came about and Ethereum came about is when we started seeing institutions looking at and exploring the use cases of blockchain in finance. Right? So we'll start with you. And you were working in the Greater China region, and in China in general has been more receptive to blockchain. They've had a blockchain strategy 3-4 years ago as a national strategy. What were the key elements that institutions were looking for here in this region when it came to blockchain?
So I'll take a step back before that. And you mentioned right, that, a lot of this, a lot of technology itself started way back in 2009, which is not a long time ago if you look at the grand scheme of things. Now, and part of what you mentioned and the big missing chunks in it is what led to the genesis of Xals in the first place, which was the fact that, even in some of the roles where I was looking at, okay, we need to use blockchain for supply chain traceability, we need to use blockchain for XYZ. It used to take years and years for an institution to identify, build, implement, and actually commercially use something. And a big reason for that from where we saw it, and that's also what created Xals, was the fact that institutions, by the nature of what they are, do not think like individuals. So organizations, people have to figure out internal privacy between teams, between different jurisdictions. You have to think about data residency. You have to think about the fact that people leave organizations. It's very normal.
Sure.
So none of that technology was actually built and set up for institutions to adopt as is.
Okay.
And it's not the nature of, or it's not the forte of a financial institution to be thinking the architecture and building these pieces out versus what is their real business. Similarly, it's not the business of a manufacturing company to be thinking around these pieces versus focusing on what is their forte. And that's what led us to be kind of saying that, here is an amazing technology. It can solve for N problems on this planet for large institutions. But they are not productized today. And either one has to go through the route of, let's give a service project to somebody and then, let's take years to build that out, which means somebody has to write a project brief. By the time it gets done and implemented 3 years later, you realize your business has also evolved and the requirements might have tweaked. But that's not the approach that is taken with a lot of other technological solutions that are required by institutions. So the genesis of Xalts was that how do we take this technology, build blockchain infrastructure for institutions? We narrowed it down to financial institutions in a way that can actually be leveraged by them in an out of the box way with whatever little bit of customizations depending on their internal processes and workflows that might be needed. So that's doesn't answer your question as is, but that kind of,
that builds up to what we're looking at, right?
Yeah.
So, Ashutosh, when I come to you, right, work for a financial institution for the vast majority of your career, from all of your career, right? And big names, in that sense, not necessarily friendly towards, at least previously friendly towards innovative technology or disruptive technology. Let's use that. What led you towards saying, hey, I need to build something outside of this institution, and what brought about Xals for the two of you?
Honestly, I was waiting for somebody else to build what we are building.
Sure.
Right? And I would have been very happy. Because when I was there, throughout like somewhere around 2017 is when you had the advent of everybody from R3 to digital asset to Ripple, Ethereum, everyone, right? And you had solutions, especially in my world, which was treasury. You had HQLA and all the other companies coming around. But the problem was not so much about, when we wanted to adopt a lot of it. It was the amount of work we had to do. Again, internal orchestrations, what Supreet was saying, that, what somebody can build you something, but internally, how do you orchestrate it? And, so these were great companies. These are great companies. They do a lot of good things. But when it comes to adoption, it's still very, very slow, purely because the amount of work I will have to put in, the amount of internal budget I would have to get in, be it being done by my IT team or be it being done by an external vendor. Right. So that to me was every time I have to implement something in the bank and basically going through the same process to practically 80% of that implementation looking the same. Right. So, and that was even more true when it came to blockchains.
Sure.
And because in any, let's say, in a large banking industry or in large bank, think about wealth management, treasury, you have commercial banking, you have 10 other things. When you are, and everyone is thinking that blockchain will help them. The first question they ask is, how will the custody do? And they're all asking the same question. They may be talking to 10 different vendors. The next question they ask is, okay, private chain, public chain, all of those other things. And then finally, how will we integrate this with our internal systems, orchestrate a journey, all of it. Today, when somebody does this, you effectively, partly because of, all these processes, it gets delayed, it takes time. And by that time, technology in itself has evolved.
Yeah.
Especially through in blockchains. Like what Ethereum was in 2017 was not what it was in 2020.
Okay.
So that is kind of what I was hoping that somebody would give me a stack as simple as, I like to call it the Adobe equivalent for blockchains.
Okay.
Purely because, again, 30 years ago, you wanted to build a website, you needed HTML program. Enter Adobe, you still need 2 HTML programs, you don't need 300. Right? So I was waiting for somebody to solve that stacking problem. And then we didn't find it, so we said this is a big wide space, and it seems like everyone wants to do something, but is delayed by this or cannot afford to do this. So that's what we solve for.
So what does Xals do? What are you solving for?
Productization, as I said, Adobe, right? Like it's effectively productization in a way that. Say, think about digital liabilities, right? Like very hot topic in terms of I want to create digital tokenized deposits or purpose-driven digital liabilities, all of this. Stablecoin is one type of digital liability, which is a very straightforward answer. That the contract is narrow, it's built in a certain way. If you have to do it in a bank, that journey wouldn't look just like mint, burn, and freeze. It will be basically paying your internal AML provider, paying transaction monitoring service. There probably will be an orchestration of 15 steps before you do a transfer or before you receive a transfer. In those 15 steps, I would be talking to internal services. I would be talking to external providers. Probably the starting of that orchestration could come from a mobile application, could come from an internal application, any of those. The end journey could be depending on where the deposit was destined for. The custodians might differ, purely data residency, capital requirements, all of that. Right? So the journey is multiple from start, and the finish is multiple variations. The technology providers are multiple variations at the start, at the end. The integrations are different, and in between you have an orchestration which continuously evolves. Right? And it would evolve for, say, in the context of India, it might look completely different than in the context of the US.
Sure.
Right?
So TLDR, we are in the business of enabling movement of data and value across systems for financial institutions leveraging blockchain.
I like the longer version. I'll tell you why I like the longer version. Largely because I think there is a lot of conversations that take place about how simple blockchain is, right? Plus, bank, what is the layer, right? And a lot of people build, including fintech, blockchain entrepreneurs, without realizing the other element of it, knowing that depth of, as I said, 15 orchestrations, the AML flow, all of that is actually very complicated. Not necessarily from how complicated the process is, but just the integration of that and understanding the steps. You miss one step, you have to maybe start again because of requirements of AML, KYC, compliance, and other things that govern large institutions, both regulatory as well as internal controls. Right? So when you are doing what you're doing, how are you able to navigate this given a lot of institutions, banks, financial institutions broadly, don't onboard technology vendors and startups easily. Let's put it that way. And it takes a long time, especially without a track record. Okay? So when you started off, how did you crack that value proposition and get into the ecosystem?
So the simple thing is you have to build the technology in a certain way, as you said. Right?
Yeah.
If you think about all of this, probably a little easier. But again, the other part is the background of the team. We also were very lucky that Citibank invested in the company.
Mm-hmm.
So that helps. But by and large, I would say the banks are actually very receptive of new technologies and at least working with the new technologies. Yes, it's a slow sales cycle. It's not as simple as consumer products, but you have to build yourself in a certain way, right? Like it's not just about the tech we are building. It comes down to the processes of the company itself you have to build. Most startups don't start with the idea that, how my internal data and compliance process would work. We did, right? And that way it also helps. So right now when we go through a due diligence or a technical due diligence with a bank, over a period of time, that muscle memory has been developed. It was a little, the first couple of times was a little harder, but now we do have that muscle memory.
So when you're dealing with potential clients and conversations, plus the team and you pitching the idea, what are the key things you keep in mind when you're talking to the institutions and people on the other side who are from more traditional finance, as it were?
So I think a couple of things here. It's very easy to be so much in love with the product and tech that you are building that you end up forgetting that on the other side somebody is solving for a problem statement and not necessarily just looking to adopt a technology because it's a technology. So I think keeping that in your mind is the first and foremost thing. That it's super easy to get lost in how great the technology was, but it's basically what we keep reminding ourselves and to our teams internally as well that at the end of the day, you're selling to somebody who is not going to read ERs and white papers.
Sure.
That person is solving for a pertinent business problem statement in their organization. Blockchain or anything else from an infra point of view, whatever is underlying, is a way to solve for that. Two is about the resiliency of how do organizations think. And that's where also a bit of that mix lies of, where the team comes from. You need the agility because you're a young company focused on scaling. Yet you also need the muscle memory of how organizations think. So how do they think about internal infrastructure and operations around data privacy? How do organizations tend to look at partners they want to work with in terms of internal operational processes and what happens? Business continuity, we were just talking about that before we started the podcast. And all of these things are something we realize it's far easier to build it out from day one in our ethos as a company, especially because neither of us is a 22-year-old founder. We've been in large organizations and enterprises, and that's actually something we take as our advantage, that we also know how these organizations think. It's been on us to ensure our larger teams also inculcate that. That's how also we engage with clients in financial institutions and other enterprises in terms of a product portfolio.
So how do you plan for, you both come from understanding how enterprises work and the enterprise sales cycle and onboarding cycle, right? It's long, right? You can only shorten it to a certain extent by saying, hey, we have everything ready.
Yes.
So you're saying a few weeks, essentially. So how are you, when you're looking at Xalts and Xals and your team, how are you building it up, right? In terms of being able to respond to this timeline, but also conserve capital in terms of having too many people on the bench and probably getting bored. Right? So how do you guys approach this?
I'm assuming nobody's getting bored.
I mean, or generally, technically, sometimes you get this.
But I think sometimes it's, especially when you're working with enterprises and financial enterprises and use case, it's very easy to get bogged down by the scale of every single thing.
Yeah.
Yet for us, what's been very critical is ensuring that we stay sharp. Whether it's staying sharp in terms of the use case of the technology, and we'll talk about that. Whether it's in terms of staying sharp in what are our focus markets, because again, onboarding and client, this thing, it's not just a sales cycle, it's also the right hit count. It's also being present in the right market. It's also ensuring that your product and operations can scale for that market, that the inherent understanding of certain compliances and regulations which also exist for our clients are known to us.
Sure.
So it's basically essentially being about being sharp, and just keep being sharper than tomorrow, than yesterday.
And product build?
Yes.
So that also comes down to product build, right? One of the things, if you think about, let's say, tokenization as a technology, technically you can tokenize that.
Correct.
Right? And there are companies which say everything from I do real estate and I'll do bonds and I'll do stocks and everything from art and all. Actually, yes, purely at a smart contract level, that is true. And if that is the only thing you're doing, maybe that was great 5 years ago, but today smart contract writing is very simple. Right? It comes down to deep domain expertise in the markets, in the specifics you play. Right? And that for us was a journey. That the underlying infrastructure took us some time to build. And then we didn't specify that these are all the things which we want to serve for, because we were building the foundation. From there on, we were also very clear. We were clear on the markets we were playing and the financial institutions. But again, think about a Citibank or an HSBC. It's everything from wealth all the way to commercial banking and markets and securities, right? So where do we play? And for us, that has been, into two areas. One is digital liabilities, which is, and when I say digital liabilities, it's a little bit more specific around purpose-driven digital liabilities. So I am not trying to build a new or a better technology for stable coins to compete with some of the existing players. But we do have the technology when you want to create stable coins for a regulatory sandbox, or when you want to create digital deposits for a bank, or purpose-driven liabilities where your payment obligation is solving for trade finance or deep tier, right? Like there the technology is the same, and bulk of the domain expertise that comes with dealing with regulated liabilities is basically similar. So that is one part. That is the L in Xals. The A in Xals is effectively about, again, the asset side is very focused around certain types of domains, primarily in what I would call commercial banking. Okay. To some degree, where there are overlaps, let's say in case of credit, there could be overlaps, but we specifically try to not do everything even in finance. Because yes, the product build would look one way, but when you are building, let's say, tokenization product for a low frequency financial instrument, it's a very different build-up relative to a high frequency financial instrument like a payment obligation or even securities. So that way, the product build out has been a very, very focused.
I'm going to ask this is almost a rhetorical question, should have been asked before. Why blockchain? Why blockchain? Right? Why should anyone use blockchain and not a combination of existing other technologies, right? Or systems, etc. Why should they integrate with new technology? Is it stable? Is it not mature? Why blockchain?
See, blockchain as a technology is not that new in terms of like what I would call distributed databases and all of it. Right? There are a couple of things, right? Say a simple example like data resilience, and this is something we solve for leveraging blockchain. So a copy of a transaction, or where I would call a central counterparty risk. So think about a simple transaction where, 4 parties are involved to effectively create a letter of credit. Everyone needs to have the same copy, and yet trade by itself is multi-jurisdiction. So the data of one party cannot move out of that particular jurisdiction and data of the other one cannot. And that's effectively a blockchain can be solved for unless you have a central trusted party, which is usually a multi-sovereign entity of sorts. Or you have like regulated infrastructure in case of, say, payments, in case of retail payments. You do have regulated infrastructure which acts as a single counterparty. If everyone trusts it, then it's fine, right? Like, and in certain other places, you shouldn't be using it, right? Like where an API can solve your problem, you shouldn't over-index it on a blockchain.
I think that's an important element and lesson for generally founders where you try to sell for all solutions. It can solve, the blockchain can do it, but you really need it, right? And that's the value that a lot of clients are looking for. It's like, because I usually push that, like, there is a definite case, and you've made a very good case for why it's required. And a lot of times people just say, oh, because it's more convenient, right? It's more efficient, but not really being able to articulate. You could say, hey, you already have oracles and SAPs in the world who could do distributed databases with copies real time if you need to, right? All of that is there. Supreet, now when you're going to your banks and you're talking about, you've now said, okay, why blockchain is needed? Why Xals?
I think why
not go to one of the larger consortiums or others who've been doing this for a few years and worked with the banks?
I think there's a fundamental difference between how fintechs, what we've been very clear about is that we are not going to ever compete with banks. We want to be working with banks and enabling banks and other enterprises in leveraging technology.
Sure.
And again, I'm not saying just blockchain technology, because of course, for all of this to work with internal systems and orchestrations, it requires a lot of things, right? So, and maybe tomorrow it requires something else. But why Xals essentially in the end of the day comes down to a couple of things. What is the approach that we have towards solving a problem statement? And in our case, it's about solving that problem statement rather than let's work with blockchain. Two, it's about, again, the ethos of, the company, the founders or investors, which are very, very large institutions. So it's Accel and Citi. Three, it ends up being about how are we, where in the entire layer do we see Xals? How it fits into not just where banks are today, but also where it could be going tomorrow. And that essentially becomes everything. I'm not, there are great companies in this world, but there is a vast difference when you're solving for a problem statement from a business point of view with the idea that this is not the only thing I'm solving. With a lot of consortiums, it sometimes ends up being that this is the only thing I will solve for, and that's it. But a relationship between a large financial institution and any of their teams or any of their clients is not just about one thing.
Okay. And actually, what we do in this space, I haven't seen anyone else really do that. There are a couple of companies which are doing similar things, but have taken different approaches, right? And otherwise, see, we are not a blockchain, so we are not an L1, L2 or any of that. We are also not a custodian or a wallet provider. We are probably also not a tokenization. Right? What we are effectively is, yes, we have the entire studio for you to tokenize everything, but we are not indexed on any one. We are basically indexed on how do you bring everything together in one single space and orchestrate that journey very, very quickly. With the added caveat that there needs to be privacy, resilience, and all the beautiful things that come with institutions.
So is it a sense of bringing modular elements together? Right?
Yes.
Are you married to a blockchain or blockchains in some senses? Or is that just dependent on the use case? You use different layer ones, layer twos, whatever it is. How does that work if you were getting
Actually, we have been, we started with the idea of full interoperability very early on. The first set of products which we built were EVM agnostic. So they were EVM, but we could practically do everything from public blockchains to private EVM implementations as simple as a Beam client or Hyperledger based, all the way to sidechains like subnets to public blockchains. Over a period of time, we have added, we have kind of segregated that smart contract layer which interacts with the blockchains directly to add functionality with chains which are not inherently EVM. And we continue to add more and more. But that requirement is driven by the institution for me. So just because I can add every blockchain doesn't mean we should be adding it today, but it takes us a few weeks to turn on a new layer unless the entire client or the smart contract layer needs to be redone, at which point it will take long.
So it's probably a slightly dumb question to ask, but is this a case of building distributed ledgers or DLTs with the centralized controls because for institutions, or are you leveraging off public blockchains and forking them out to build
neither? So institutions actually, just to go on that point, couple of years ago, it was all about private blockchains, but it has evolved to where today a lot of the institutions which work with us are primarily working with us because of our EVM layer, because they want to start working on public blockchains and use cases there. the way it has been set up is, think about there is an orchestration layer above which is the smart contract layer, which interacts with your, any version of a blockchain. Now, those blockchains are not ours. We don't actually do blockchains ourselves.
Yeah.
We can help you set them up, but there are other players and you can set them up yourself. Orchestration layer, how that orchestration layer needs to interact with your smart contracts, right? In certain cases, it could be public relay of information through oracles. That's one way. That's also what you would see with a chain link. But in certain other cases, I, as an institution, don't want my AML to be relaying to a public, oracle. I need it to basically feed directly to my smart contracts, metadata, or some version of it. In certain other cases, I need my smart contract to be wrapped in a certain way so that while it is on a public blockchain, it masks a lot of information.
Sure.
And below my orchestration layer would be integrations, with my third-party systems, but also to my custodians, to my AML providers and things like that. So my entire use case is, not, as a bank, is something needs to be done at core banking level. I also need chain analysis or a TRN labs to do transaction screening. I need a Fireblocks to do my custody. I then need to basically build orchestration myself, which interacts with all of this. And then I also need smart contracts, which are done in a way that they are light, yet take care of my requirements. So I don't use, while I use standard ERC contracts, I have some modification in it. And then I need to figure out how they talk to the chains and relay information back and go back again to the orchestration, right? Like this is typically an implementation. We have done all of this for banking institutions start to finish in less than a week.
Wow, okay. That's super fast.
Because for a lot of these guys, we also have pre-integrated systems. So you don't need to then worry about how will I integrate my wallet providers, how will I integrate custodians, how will I think about, say, if I'm a large bank and building for, where I need 1 million wallets. What is the identity link back from a wallet to my backend system? All of this is orchestrations or collection of orchestrations which need to talk to each other. So everything can be done very, very quickly.
And so how do you guys achieve this orchestration with other partners and integration? So one element of, hey, you understand the bank well, you understand the processes well, you're able to speed up on that. But on the other hand, finding the right partners, the system whom the banks are comfortable working with, and also having a technology that integrates relatively fast in the time frame we're looking at. So how do you approach these partnerships and integrations with, for lack of a better word, third partners in the system?
See, a lot of time it ends up even being in the ecosystem that, what are the kind of custodians, what are the kind of companies that are financial institution customers themselves are more comfortable with.
Sure.
And that's always a function of, what are they either already working with or what their compliances have already signed, compliance teams have already signed off on. The other ends up being, similar to us. There are multiple ecosystem partners where they have, been battle tested by, institutions. And that's where, again, the synergy is a lot higher. The approach and way they're also thinking is a lot more synergistic in that way.
And building on this, right? A lot of times people confuse tokenization with crypto, right? And I think it's very important in this seminal year in some senses where real-world asset tokenization and a bunch of other blockchain infrastructure integration that yourself are doing and a bunch of banks and SIP are doing, for that distinction. There's a lot of hoopla around saying, oh, sort of cryptification of banks taking place. There's that probably is more on the asset management side from the BlackRock side. So how are you distinguishing between crypto and tokenization? Very simple answer.
Yeah. One is a technology, other is a process.
Yeah.
Right? It's as simple as that. And tokenization, the process, generally requires more than just crypto, the technology. It requires, and when you say crypto, the technology, what I mean by that is smart contracts, blockchains, what have you, right? Like public, private is a matter of choice, matter of jurisdiction. But it's tokenization, the process, wherever it has worked, has not just been about let's take this asset, keep it in custody, issue a token, and be done with it. Right? That used to be a thing. But today it's an entire end-to-end. You mentioned BlackRock. For that matter, some of the work that has been done under Project Guardian, or by HTML here in Hong Kong. If you look at the architecture diagrams, it's more than I think just smart contracts, right? It's a lot of other things, and that is what we are talking about. That it takes a lot of these things to come together, and now they can come together very quickly, very cheaply, very easily using us.
And where do you both see 2024, 2025 for both yourselves and as well as the industry? Talking this year in office.
I think for the company, of course, focused on scaling. There's specific markets, there's specific use cases that we are focused on. And of course, building the team in order to be actually scaling that. Two of us can't do everything on our own. I think at least, and maybe I'm speaking on behalf of Ash as well, I'm assuming that, where both of us will be is still in front of a client or a laptop
Sure.
in one of our offices across
They're well funded,
different
right?
markets.
Yeah.
So in front of that, Ash may be, talking about, the architecture for a new product that we build into the pipeline, and me may be either working with our sales team or in front of a client and ensuring that, that's also transforms to revenue dollars for the company.
So what markets are you in now, and are you looking at any new markets?
So markets-wise, predominantly, we follow the client, right? Till now, a lot of our clients have been a little bit, they are global, but the implementations have been either in Asia or MENA. But as we start to see this year, right, like you have seen a few positive things happening with the US, and to some degree, Europe was always actually very open. But those are the markets we will follow.
Okay.
So we do have plans to put feet on the ground in some of these markets. One thing we don't do is we don't actually open up to a new market till we have feet on the ground.
Sure.
And that's something that's just common sense when it comes to selling to large organizations. You do need a lot more in-person interactions, and it's more frequent. So that's something we do as a choice. It's very excited about opening up in London and later this year and early next year in New York.
Sure.
So we just opened up in Singapore as a proper feet on the ground operations.
That follows your acquisition as well. Do you guys want to talk a little bit about that?
I think the acquisition of Contour, which we did in early February this year, was a lot more to do with, again, adding more pieces into our product portfolio from an IP point of view. And at the same time, looking at things from, again, a company which has existed prior to us, has been battle tested longer than us. Getting that know-how and that learning of every single aspect from operations and resilience. So that's what the acquisition was focused on. And we just completed 100 days since the acquisition last week.
Yeah, but like, look, there's absolutely no shame in admitting that we don't know a few things, right? Like when we acquired Contour and the way things were set up there, it opened our eyes, right? Like what we were 100 days ago as Xals relative to what we are today, even in our processes, is exponentially better, right?
More resilient.
More battle tested internally, all of those things. Yes, technology again is one element, and working with clients is another element. But the amount of thought that had gone into building Contour, and I have seen that company purely because of HSBC, right? Like for us, that was one of the big elements that there is so much to learn from us. They were predominantly working with banks. While we would like to think that we are getting there, can we short circuit a lot of that learning today? And as a company, we are much better off just learning from that. From an IP point of view or the portfolio point of view, again, similar problem statement, right? Like Contour was also trying to leverage blockchain to address a certain problem in what I would call credit trade. So it's not very different. The technology stack over a period of time evolves for everyone.
Yeah.
So for us, it was more about one soft learnings in terms of how to build a certain resilience into the company, both from a hard infrastructure and soft infrastructure point of view. The other bit is in terms of, an added advantage in terms of now we can also solve for this.
I think it's also a good lesson in the sense that unlike, say, very large tech firms who may acquire competitors early on, Facebook is a classic example of Insta, WhatsApp, just integrate because they couldn't do themselves. And attempting to buy others with Clubhouse is a classic example of they couldn't. But for young startups, relatively, you guys about 2 years now into the process, to go out and integrate beyond, say, the cost of acquisition and other things that important saying what we can do, which can be synergetic, right? And founders shouldn't necessarily shy away from exploring that as an option as strategically as acquiring talent or new markets. So you may end up spending similar amounts, but you're not thinking about the softer element, as you mentioned, their knowledge of being with financial institutions and all of those lessons that we get, processes, etc., which are ahead of the curve and mature. And to be honest, I think unfortunately after 2023 and parts of 2022, there'll be quite a significant number of fintechs in the region and beyond who have suffered, and some of whom are looking at M&As or looking to acquire, or may end up dying. Right? And I know of personally a few who have died recently. So I think this could be an opportunity this year for some of the healthier startups to kind of shop around, as it were, to integrate. Right? It may be a useful lesson. It doesn't mean that you need to be really large to acquire. And I think what you guys have done is kind of shows that as well. And final segment more so is about your entrepreneurship journey. Right? So I want to start with how did the idea of the two of you getting together for this about really finding that founder? Right? How did that process work? It's very tough. Finding a co-founder or two, but secondly, having that right person to work with and building companies. As good as raising a family as this is.
I'll let Ash answer because he asked me to come and be part of his vision.
It was like, look, we knew each other for a while.
Sure.
So there was that inherent friendship and trust. But more importantly, it was about complementary skill sets. There are certain things I absolutely don't want to do, which he's very, very good at. And similarly, it's the other way around. So that complementary skill set is also very necessary. But it's also, at the end of the day, is the other person as passionate about the problem you are trying to solve for?
Yeah.
And if they are, then it's just easier. So it's trust, passion, and complement. this is what I think is the best.
Holy Trinity.
Just passion, company, what they're trying to see, right?
But
Why did you find this vision aligned with what you were doing? Because that's always a very bigger challenge. Is you have somebody who has a vision, it's easier to drive it because you feel the pain but to believe and buy it in today's world is a challenge. How did that come about?
So one, we both didn't wake up, or I'm assuming, Ash didn't wake up one day and say, I want to start a company and called me up, right? It didn't happen that way. It was very organic over several months where, we would spend hours and hours over Google Meet and Zoom and, just keep discussing a lot of things, validate, talk to, people we knew from our, careers in terms of sharpening and, being very laser focused on the problem statement at hand itself. I think it was over a period of time where you start seeing that he's seen that same problem statement from a one lens. I have seen that problem statement from a different lens, which is where I'm sitting in large corporates and enterprises and again, as a business operator, like, are you supposed to know technology or are you supposed to be solving for your business problem?
Sure.
And so Xalts or Xalts, the name came about later, but that entire thing of, okay, let's start building this, it was very organic. It was not about, hey, I'm on a hunt for a co-founder and hey, I'm on a hunt for somebody who has a vision.
Or even I'm trying to build a company.
Yeah, it wasn't even I'm trying to build a company. I think in his head and in my head, we were just working on some of these things on the weekend, trying to figure out, and organically it started shaping into a company. And the minute we both realized that, okay, now this is shaping into a company, it was extremely organic to say that, let's do it together.
And what was the tipping point, as it were, to leave
Our
jobs,
careers.
very well paid with top institutions, global recognized institutions?
I think
where
the
they come from,
tipping point was
and in the middle of COVID.
It was actually, the tipping point wasn't as much that one day we realized, okay, we are ready. It was, you rightly said, right? Like, there was something going on in life, right? Like, which was good. So to leave that and do this, and it's a bit of a adjustment. So we, at least I personally looked at it from risk reward ratios.
Yeah.
Trader, right? Like, so what am I giving up, and what am I trying to do this for? And after a while, when you start to do all of those adjustments, at that point, we decided that this is the right move. And it was actually, when I thought about the risks, there's not a lot to lose after a certain point in each of them. Right? Similarly, the reward is not so much about just monetary. Right? Like, for me personally, it was more like, if I don't do this today, probably 5 years down the line, I might not want to do this. So it was also that opportunity cost and things like that, which is kind of what led to that.
Yeah, traders all wire the same way. Honestly, no, it's true. I mean, having done that for a decade as well, and a lot of my organization, which is first where I started my career, my general manager is a trader, my country head is a trader, the company's chairman is a trader. So all decisions are all about risk reward, right? And that translates into our personal lives, into everything else. In some sense, you just get wired, and that just becomes the process.
Honestly, like, simple thing, right? Like, now I'm running a business.
Yeah.
Right? Like, it's well and good for me to say, hey, let's just run after this problem and, come what may. But you do have to think about the risk reward and what am I solving this for? What will it come down to? On it, I think a lot of startups don't think enough about risk rewards.
It's a passion project, solves it.
Passion is nice, but the minute you have to translate that into a business, you have to, while you need to be passionate, you also have to be brutal about, I might be really, really passionate about solving this, but this might take 10 years. Today, this is going to keep the lights on, but it's a diverging road to my end goal.
Is it? And I'm just building on this conversation because it's very fascinating from an entrepreneurship perspective. I know of a few founders who have nearly lost everything. It was just family here in Hong Kong. Someday I knew and he was like, I'm down to my last $1,000 on waiting for an investor, or you've been waiting for a client to sign up. It was taking 6 months, it's still waiting. It's like, I'm literally down to my last $1,000. Luckily, it's in the middle of COVID and now doing very well. And there are others who believe that they need to be at the stage where they're willing to risk everything, and without that, they can't succeed. For me, it's a bit like when you're doing the high jump or the long jump, you give everything, it doesn't hold you back. How do you balance that?
I think the reality of being an entrepreneur is that every single day you have to be brutally ruthless with yourself about every single decision you are making. And the end of the day, also be okay to live with whatever decisions you've taken. Will I say that, it's about let's just run after something with no end? Maybe in the moment, yes. Maybe in retrospect, not. Maybe in the, a lot of things look very different when you've come out of something, or when you're at the outer edge of something. I think in the moment, every single day is always for any entrepreneur. I think what these 2 years have taught me is I respect every single entrepreneur on this planet. Every single day is a roller coaster ride. Every single day is about living and breathing every single decision that you take. And you have to take those decisions very brutally. You have to be very ruthless in terms of prioritizing every single thing that is important. Ruthlessly prioritizing your time, because nothing is more valuable than that. And I think that's the transformation, or the outcome of it is something you only realize years down the line, right? It's during it, you're just running and you're just ensuring everything is done on it with the risk reward that Ash talked about, right? But it's only in retrospect that you start realizing that was that decision the right decision? Was I running blindly or not, and so on. So,
and this is more a question in terms of you guys were able to raise a decent amount of capital in your journey, which is not necessarily something that a lot of startups manage even after a few years. What would you say helped in your approach to get that money, especially institutional capital? In some sense, cities, Accel, and others who usually come in later stage. What do you think helped in your process to get that key factor that people can replicate?
I think we were very, very clear. We are going to play with what are our strengths. We are going to build a company in a world or an ecosystem, or what we are going to solve for is a world that we understand.
Sure.
Not something that we don't. And I think that's something that every founder has to be very clear and honest to themselves about, at least.
Yeah.
If not to their investors, that, what is their strength, what is that they truly understand and know very well.
Yeah.
The pulse of the market, it could be the pulse of consumers in a particular market, it could be the pulse of certain categories, it could be or in our case, the pulse of some of the most old school companies on the planet.
That time, making a very sharp, narrow wedge in terms of what are you going to solve for, or both like from product point of view and that really helps. And while you would think, right, at the start we raised that much capital, it's actually 2 years since before that moment. For the first 2 years was basically our own personal capital being thrown around in small chunks at, hey, let's try to build this and see what happens, and not like build a company, but build pieces of technology to see, to learn, it's basically, we did a couple of POCs. small, a few $100,000 here and there to effectively convince ourselves. And this goes back again to the risk reward that I am okay to lose this much amount of money to be able to justify to myself. And honestly, that was something of my own internal framework. That in 2020, I had kind of decided that I want to do something else. One of which was, I want to solve a couple of these problems around this. I said, I'm going to basically burn through $250,000 and I don't expect any outcome of it. If it works, brilliant. If it doesn't, no harm done. But then I would know that I'm not capable of solving those problems. So that was something we did initially. And that led to a lot of conversations about why should, as simple as why are apps designed in a certain way, or why are smart contracts working in certain directions, why are even L2s required. So it was an experiment or a collection of experiments to understand what are the edges.
Tell me if I'm wrong. Both of you are not technologists.
I'm
technical engineers, etc.
Both trained engineers.
Trained engineers, but work-wise,
practicing engineers.
Yeah, it's like the same for me, right?
Yeah.
Engineer, but
Not an engineer.
never did any building or industrial stuff in my 20 years. And I think that's an important piece for non-technology founders, especially who are looking to solve problems. And what would be some of the tips you give from? Some may not be able to afford $250 million, it may be $25,000 or whatever. What would be the key things they can do to, you see a problem? And for me, technology is always like an enabler. It's almost
It is.
innovation, right? So how do you get up to speed with those nuances which are important and being able to articulate that through?
So that really depends on the type of company you're trying to build, right? Like if you are trying to build deep tech, regardless of, problem, at least in its source, the technology is extremely deep there.
Yeah.
Right? So either you have to, as a founder, there is no escaping your course. So either bring somebody as a co-founder who understands that, or get your hands dirty. You don't have to be, know everything, and I don't think anybody does, even if they come from that background. But you have to have enough context and enough appreciation for those things. And then you learn over a period of time. So we did by getting hands dirty.
So what was your approach to building your team and bringing in the pieces where you both were not necessarily the experts?
So let me answer this. What we've seen and learned from a lot of co-founder and founder friends as well is, and we did the same, which is basically keep building the right set of people, not just for the skill that they bring, but also for the elasticity that they bring to the table.
Sure.
And to build it in a way that fundamentally what you are taking off is chunks of bandwidth and deeper expertise on that than either of us on respective fronts, right? So what in a 0 to 1 phase of a company, a team looks very different versus a 1 to 10. In a 0 to 1, our team has been a lot focused on people who are willing to get their hands dirty, very, very comfortable with ambiguity, very, very comfortable that, there's a client meeting that happens and we realize, oh shit, how we think about this is slightly wrong and let's modify it. And the team being okay to be able to have that flexibility as well, right?
Sure.
So it's the elasticity of things. I think from 1 to 10, which is, where we've been for the last several months, it becomes about there is now a point to start scaling and flywheeling. So the 0 to 1 messiness is great, but now it's time to bring in a little bit of structure. Not so much structure that, nothing can move without, 10 layers of bureaucracy, but the right structures.
Sure.
And the right structures would solve for what the company we envision it to be in the next 18 months. That means in certain functions or in certain teams, we bring in leaders who have a mix of agility and the enterprise spirit, which could either be a function of the persona or could be a function of, what they've already done over the past. So it evolves in that certain way, and that's where also certain layers keep getting, or certain functions keep getting added in the organization. We've also been very conscious of never turning the company into a top-heavy team, ensuring that, people who are growing rapidly and scaling with the speed of the company or the velocity of the company are also scaling with the company itself. So it's a journey. We'll continue to remain a journey. And we'll learn a lot along the way as well.
It's an excellent journey. Sorry for the pun. Thank you both. We look forward to catching up with you when you go from the 10 to 100 space in a few months' time. Thanks again for your time. We're learning for our viewers, ranging from understanding live blockchain for enterprise finance to the entrepreneurship journey, but also, the biggest takeaway is about that understanding of having a solution to solve a problem rather than just taking a technology and trying to find
Problems.
where it fits in. Right. Yeah. So that's an important element and being able to integrate with the ecosystem in a timely and almost agile manners. So thank you both. Ash and Supreet.
Thank you for having us.
Stay tuned. Keep following Finstep Asia Edge on all of our social media to listen to more great stories from founders who are creating magic in the Web 2 to Web 3 world. Thank you very much.